$1.2 trillion. It's one of those numbers that just feels completely abstract.
It really is. I mean, you're talking about the entire GDP of a country like Indonesia.
Exactly. But we're not talking about a whole country's output today. We're talking about a surplus, a trade surplus.
Which is, in effect, the net amount of capital flowing into the Chinese economy from the rest of the world in just the last year. It's staggering.
And that brings us right to the paradox, the core contradiction we need to get into today. Because in any economics textbook, if a country runs a surplus that big,
The currency should be going through the roof.
right, demand should be insatiable. Everyone needs your currency to buy your goods. But the Chinese yuan, the CNY, it just hasn't. It's been surprisingly tame.
And that's the mystery. We're looking at what you could call the Chinese yuan paradox. And we're basing our deep dive on a really detailed report from JP Morgan's China Local Markets team. It just came out a couple of days ago, January 17th, 2026.
Yeah. And this report, it gets right to the heart of what they call a structural bullish risk. That's the term they use.
It's like the market is sitting on a powder keg of potential appreciation, but, the fuse just hasn't been lit yet. So our job today is to figure out why that fuse is damp and what could happen if it finally dries out.
So we're looking at three main things. That monster trade surplus, a record-breaking sell-off of dollars by Chinese firms in December, and how the central bank is trying to manage it all.
And we have to touch on the monetary policy side, too. A lot of bond investors got caught on the wrong foot recently. But let's start with the big one, that surplus.
Okay, the headline grabber, $1.2 trillion. I struggle to square that number with everything we hear about tariffs, decoupling, friendshoring.
You'd think those rising trade frictions would be choking off the flow.
They should be. So how is China's export machine just printing record cash?
Well, that's the first really interesting thing the JP Morgan analysts point out. It's not that the friction isn't real, it's that China has successfully diversified where all those goods are going.
So the map has totally changed.
Drastically. The reliance on, the U.S. and Europe is falling, at least in relative terms. The real growth engine now is the emerging markets. And the report specifically calls out ASEAN.
Southeast Asia.
Exactly. Exports to ASEAN and other big EMs now make up almost 35% of China's total exports. That's a massive structural shift.
So instead of just sending everything to Long Beach, they're plugging into the supply chains in Vietnam, Indonesia.
Correct. Which makes those simple trade barriers a lot harder to enforce. But, a surplus has two sides, exports minus imports.
Good point. Is this record just about selling more stuff, or are they also just not buying as much from the rest of us?
It is absolutely both, and the import side tells a really fascinating story. The report calls it an import substitution campaign.
The push for self-sufficiency.
And it is working, especially in tech. JP Morgan says that since Trump 1.0, they've made real, visible progress in making their own high-tech parts. Think about it. 5 years ago, a Chinese company building an EV might have imported 40% of the high-value components.
Yes, now.
Now it might be 10%.
So all that money that used to flow out to buy chips and screens from abroad is just staying home.
Which mechanically blows up the trade surplus. So you've got these resilient exports finding new homes, plus a structural drop in the need for foreign tech. That's your recipe for a $1.2 trillion surplus.
Okay, so that sets the scene. The cash is just piling up. Which brings us to what happened in December. The report flags this specific data point from SAFE, their foreign exchange authority. A record.
$100 billion.
Wow.
In a single month, Chinese companies sold $100 billion of US dollars to buy their own currency.
And these are the exporters we were just talking about.
Yes. For ages, these firms were just sitting on their dollar earnings, hoarding them. But in December, something changed. They all seemed to run for the exit at once.
100 billion 30 days is.
Right.
That's not a trickle, that's a flood. What happened?
The report points out that the FX conversion ratio, basically how much of their foreign cash they swap back home, jumped by over 8 percentage points. That's a huge behavioral shift.
So it's like they lost faith in holding dollars.
I think it's more a change in the risk-reward math. You have to think about carry. For a long time, holding dollars was a no-brainer. U.S. interest rates were higher than Chinese rates, so you earned more just parking your cash in USD. That's positive carry.
But that's only if the exchange rate doesn't move against you.
Precisely. If the dollar starts to weaken against the yuan, that currency loss can wipe out your interest gain pretty fast. The analysts suggest exporters started getting worried that the yuan was, finally due for a real rise.
So they looked at their big pile of dollars and thought, this isn't worth the risk anymore.
And that creates a feedback loop, right? A few big players start selling, the yuan strengthens a bit, which makes holding dollars even more painful for everyone else, and that just triggers more selling.
Okay, but this brings me right back to the paradox. If $100 billion of selling pressure hits the market in a month, why isn't the yuan at, historic highs? Why didn't it just smash through every ceiling?
Because you're just looking at the flow. You're looking at the water coming out of the tap right now. You're ignoring the giant reservoir it's coming from, the stock.
The hoard.
The hoard. And this is the number in the JP Morgan report that really puts it all into perspective. They estimate that Chinese exporters have piled up excess dollar savings of somewhere between $610 and $930 billion.
Almost $1 trillion. Just sitting there in corporate bank accounts.
Accumulated over the past few years. Yeah, it's a massive, massive overhang in the market.
Okay, that makes so much more sense. $100 billion is a ton of water. But if the market knows there's another $800 billion in the tank behind it, it prices that in. It acts as a kind of dampener.
It's like a dam. The $100 billion in December was just one sluice gate opening a little. It made a splash for sure, but the reservoir is still almost completely full.
That sounds incredibly risky for the whole system. You have nearly $1 trillion of potential selling pressure just hanging over the U.S. dollar.
That's exactly what the report means by structural bullish risk for the yuan. The natural path of least resistance is up. That money has to come home eventually. But it's not a panic because the central bank, the PBOC, is managing the whole process.
Right. Let's talk about their role. They're not just spectators here.
Oh, no. They are very active. Their main tool is the daily fixing. Every morning, they set a reference rate for the yuan, and the market can trade in a band around it. And JP Morgan notes they've been setting gradually stronger fixings.
So they're basically telegraphing to the market, we want the yuan to go up.
They are, but the key word is gradually. They're steering the ship. They're not strapping a rocket to it. The report's view is that the PBOC wants a moderate and managed yuan appreciation.
Why only moderate, though? If you have this surplus, why not just let the currency rip and reflect that reality?
Well, because a currency that appreciates too fast absolutely hammers your exporters. Suddenly, all your goods are more expensive for the rest of the world. You could kill the golden goose.
And given all the trade frictions we already talked about, they probably don't want to hand everyone another reason to source their goods from somewhere else.
Exactly. And then there's what the report calls the realpolitik of international FX management, meaning the optics are important. If you're running a $1.2 trillion surplus and your currency is artificially weak, you're just inviting accusations of manipulation and, retaliation.
So by letting it drift stronger towards that 6.85 level that JP Morgan forecasts, they can say, look, the market is working.
It's a balancing act. Let it rise just enough to keep the U.S. happy and encourage your own companies to convert their dollars, but keep it low enough so your exports stay competitive.
And this leads into the most technical part of the report, but maybe the most important, the RER.
The real effective exchange rate, yeah.
Okay, break this down. This isn't the number you see on your screen.
No, that's the nominal rate. The RER adjusts that sticker price for inflation differences between countries. It's a truer measure of competitiveness.
And the report says there's something weird happening with it.
A unique divergence. See, usually when a country's RER plummets, it's because their currency crashed. The nominal value just fell off a cliff.
Right, like we've seen in Turkey or Argentina. But the yuan hasn't crashed.
Not at all. The nominal yuan's been pretty stable. But its RER, the real rate, has dropped a lot. And the reason is the inflation differential.
Say more.
It's just math. For the last couple of years, the U.S. and Europe had really high inflation, right? Costs went up, maybe 20% total. China had almost no inflation. It was borderline deflationary.
So the price of making something in China stayed flat, while the price of making it everywhere else went way up.
Exactly. So in real competitive terms, Chinese goods got way cheaper. The RER went down, even though the nominal exchange rate barely moved.
So the PBOC kind of got a free pass on competitiveness?
That's a great way to put it. The report calls it an abnormally large gap between the nominal and real rates. It gives the PBOC all the breathing room in the world. They don't need to devalue their currency to help exporters because inflation in the West already did it for them.
And they don't have to aggressively hike rates to fight inflation because they don't have any.
It just validates their whole slow and steady approach. They can afford to let the yuan creep up towards 6.85 without causing any real economic pain.
So that covers the currency side. But the report also talks about domestic monetary policy, and this is where I think a lot of people got tripped up. The market was expecting big rate cuts.
Oh, the market was positioned for it heavily. Bond traders were all in on the PBOC slashing rates to boost the economy.
And they didn't get it.
They did get easing, but as the report says, it came in a less favorable way for CNY rates.
Which is analysts speak for long-term bond prices didn't go up.
Right. Instead of a big broad cut to the main policy rates, the PBOC went for structural remedies.
Targeted easing.
Very targeted. They cut something called the one-year relending rate, and they added a 500 billion yuan relending quota.
And that's not just free money for anyone, is it?
No, it's very specific. It's money commercial banks can only get if they promise to lend it to sectors the government likes. Green tech, advanced manufacturing, that kind of thing. It's surgical.
So if you owned a 30-year government bond, hoping for a big stimulus that would drive your yield down, you were out of luck.
Duration failed to perform, is the phrase. In fact, the yield curve is steepening. Short-term rates are low, but long-term rates are staying stubbornly high because the market now realizes that big bazooka isn't coming.
And there's a regulatory angle here, too.
Yes, new mutual fund regulations are making it harder for funds to hold illiquid long-term bonds, especially if they face redemptions from their own investors.
So fund managers are getting scared. They're selling their long bonds and moving into short-term stuff to stay safe.
Which just adds more selling pressure at the long end of the curve. It's all very consistent, isn't it? Whether it's the currency or rates, the PBOC is avoiding blunt instruments. They prefer these complex structural tools.
It's all about precision. They're managing the release of that dollar hoard slowly, and they're targeting liquidity instead of just flooding the system.
It's a long game.
Okay, so let's tie this all together. You have a massive $1.2 trillion surplus feeding the system. You have this $100 billion sell-off in December, which JP Morgan thinks is just the start.
It's the beginning of the unwind, yeah.
And you've got a central bank using that $900 billion hoard as a giant shock absorber to smooth everything out.
The managed part of their managed depreciation.
I just want to go back to that number one more time. $930 billion, the high end of the estimate.
It's an almost unimaginable amount of latent liquidity.
We saw what happened when just 10% of that hit the market in December. It was a record breaker.
It definitely moved the needle on flows.
So here's my final thought. The PBOC has this under control, for now. But what if the incentives change? What if holding dollars becomes even less attractive? Or what if the PBOC decides it wants to tap that pool of money for something big at home?
That is the tail risk. If they were to actively encourage the conversion of the rest of that massive balance, you're talking about a tidal wave of capital moving from the dollar to the yuan.
That's not a moderate move to 6.85 anymore.
No. If that dam actually breaks, instead of just being managed, it could rewrite the entire global FX map for 2026. It would force a huge repricing of the dollar against everything.
And that is why they call it a structural bullish risk. The pressure is building. The only question is how fast they decide to open the valve.
Exactly. And the surplus guarantees the reservoir keeps filling up. Their whole job is just to make sure the pipes don't burst.
It's going to be a fascinating year to watch the fixings. That boring daily number might just be the most important number in global finance.
I think you're right. Watch the fixings. And watch that conversion ratio. If it spikes again like it did in December, you'll know the next wave is on its way.
Well, we've unpacked the paradox. Huge flows, a massive hoard, and a central bank playing a very, very careful game. Thanks for getting into the weeds on this.
My pleasure. It's all about following the money.
That's all for this deep dive. Keep analyzing, keep questioning, and we'll catch you on the next one.
Stay curious.